Welcome, everyone. My guest today is Bob Broeksmit, President and CEO of the Mortgage Bankers Association, to talk about the housing policy priorities that fit in with the Trump administration's focus on affordability and what might happen on credit reporting requirements, the LO comp rule, LLPAs, and much more. First, I want to thank our sponsor, Trust and Will, for making this episode possible. Bob, welcome to the podcast.
Thank you, Sarah. Thanks for having me.
No, thank you so much for being on in such an incredibly busy season for you and on such a big day. So we're recording this the day before the Davos event that we're going to get Trump's housing policy recommendations and lots of things happening this week. And I really appreciate you making the time.
Happy to do it.
So let's talk about what in this wild time, what are the MBA priorities? What are the policy recommendations that you're specifically focused on when it comes to you have a president who's focused on housing?
Sure. Well, it is encouraging that we have an administration that has a bias toward action, and we have been working very closely with the various agencies in the administration to articulate housing policies that we think will have an immediate and direct bottom line on consumers. So one, which we can probably get into in a little more detail later, is finally doing something about the cost of credit reporting. And we have a proposal there to move to a single in-file away from the tri-merge for GSE loans with scores of 700 or up, which we think will save consumers money immediately, both on what they pay on the closing disclosure for credit reports, but also really importantly, what's built into a lender's margin when they price the loans for all of those millions of dollars that they're paying for credit reports for consumers whose loan never closes. And other priorities on the affordability front include articulating the need for a reduction in the mortgage insurance premium for FHA loans and or a change to the life of loan requirement for those FHA premiums. The FHA Mutual Mortgage Insurance Fund, as has just been shown in their actuarial report, has an 11.47% capital surplus when 2% is the required minimum. So we think there's room to do something there. That again would flow to new home buyers and people refinancing their loans immediately upon enactment. The second one that has to do with pricing would be on the Fannie Mae Freddie Mac side, where we think there could be some across-the-board adjustments on loan-level price adjustments. Again, something that would have an immediate effect in lowering mortgage rates and could work in tandem with the president's recent announcement that Fannie and Freddie will buy up to $200 billion in mortgage-backed securities. It's always hard to say how much that affects the pricing in the market because there's so many other events going on, but clearly having another buyer or two buyers, Fannie and Freddie, in the market, other things being equal, will be good for rates. And we're also looking at things like insurance requirements for condominiums with Fannie and Freddie. There are an awful lot, thousands of condo projects that are ineligible for Fannie and Freddie financing that with sensible modernization of insurance requirements could be GSE eligible and save consumers money. So those are just a few of the ones, Sarah, that we've been pushing.
That's an incredible list, actually. And to me, what stands out is these are areas where it feels like the risk has been overpriced in. Like you could do some things here and you're not touching the safety of these things because for instance, the FHA MIP, 11.47%, when, they only need to have 2% statutory minimum, it feels like there's a lot of room there to say we can do this and it's not going to crash anything. It's not going to break anything.
Right. And we think, and we've been advocating with HUD and with FHA, that it's possible that this would be done in tandem with some kind of slight narrowing of the credit box for FHA, because I think any reasonable mortgage participant underwriter would acknowledge that FHA loans have a layered risk issue where they might have a lower credit score, by definition, a low down payment, often supplemented with down payment assistance, so very little, if any, equity from the home buyer, in addition to debt to income ratios that, let's just say, are more generous than the rest of the industry. And when you put the three together, you could make a case that at a time when home price appreciation stalls out, because you have to acknowledge that the capital ratio is where it is partly because of the tremendous home price appreciation the country's had over the past few years, that perhaps it's a joint thing where you might say, okay, well, there's room to lower the mortgage insurance premium, but perhaps look at some of the layered risk issues too. So we are the opposite of saying throw caution to the wind. We're just saying that if there's a responsible way to keep FHA, the great program it is for first-time home buyers, but make it a little more affordable in this period where home affordability is just at really significant levels and is at the top of the national conversation. Let's see if we can't move forward responsibly to do that.
All of these have an affordability component to them, all of the things that you guys are working on. Are any of these part of what you think the discussion is going to be by the president at Davos?
Well, I'm hesitant to predict what the president might or might not say. I am confident that he would talk about things like preventing institutional investors from buying a lot of additional single-family homes. This is a case where we can look at statistics and say institutional investors own a very small percentage, small single-digit percentage of single-family homes in this country, but we know that in some geographies it's more concentrated. And if you're looking for a house and you get beaten out by an institutional investor with a cash offer, it's pretty frustrating. And we want to make it easier to get your foot on the first rung of the homeownership ladder, so we can understand why that's something that the president is interested in pursuing. It seems as though it might require congressional help to get that over the finish line. But I would expect, because that does resonate with voters, that that would be one of the things that he addresses at Davos. And another thing that has gotten some press, and we've had conversations with the administration directly as recently as last week about, is helping with the down payment, but having home buyers help themselves. And what I mean by that is, if you have money in an employer-sponsored 401k and you want to buy a house, it can be frustrating to have that money be inaccessible. But to find out a way to make that money accessible for a down payment, but in a way where there's an IOU to yourself to get the money back when the house is sold, it really would have the effect of diversifying the holdings in your 401k. So maybe you've got some stocks, and maybe you've got some bonds, maybe you've got a little rainy day cash fund, and maybe you've got some real estate equity. And that, we think that's a really intriguing idea that we've heard kicked around by the administration, and one that would get to one of the barriers to home ownership, which is lack of a down payment, in a really creative way that would diversify the borrower, the home buyer's assets, and let their own retirement plan benefit from the increase in value of the real estate underlying it.
That's really interesting. I hadn't heard anyone put it that way before, Bob, but that really does make more sense when you say it that way. I thought it was a really interesting proposal in any case. And both of those things that you highlighted, I think they're easy for consumers to understand. And that's key to a lot of housing policy, right? Like when you get in the weeds, I mean, we could talk about LLPAs. It's very important to everyone in the industry and to the consumer, but the consumer has no idea what that is.
Right. And in this case, where you would effectively, one of the assets in your 401k would be equity in the house, it has the very beneficial side effect of having no monthly payment. Because if you take a loan against your IRA, for instance, you got to pay yourself back monthly. And it's always been a weird underwriting thing. Like, well, do you count the payment because you're paying yourself? And who's the harmed party if you don't make the payment? If you are attributing or depositing, in effect, some equity in the house into your 401k, you don't make a payment. It's just that the equity, let's say 10% of the sales price or whatever it is, you're making a long-term no payment loan, and then when the house sells, let's say the property's gone up 30% in value by the time you sell it, well, 10% is 13%, right? 30% increase. So I think it's got some real interest and something that people can wrap their arms around and get away from that weird thing of you're making a loan payment to yourself.
I know a lot of people don't have a 401k, right? We know many people who are out there who are working different kinds of jobs than that, or they might have their money someplace else. So let's talk a little bit about that LLPA, the loan level price adjustments for middle income buyers. And let's talk about what can be done there and what you think the effect might be.
Sure. And in our conversations with the administration, we've been focusing on ease to implementation and assurance that the borrower would see the benefit the next day, right? So we're talking about making an across-the-board adjustment, let's say on purchase loans, because we're trying to stimulate home buying. And then we wouldn't say, well, if your credit score is this and your LTV is that. We would just say for purchase loans, probably for primary residence, maybe you cut the loan level price adjustments by a quarter. And I'm just making up the number. Obviously, I'm going to let the FHFA and Fannie and Freddie do the analysis. But if they did that on a $200,000 loan, that's $500 less money to close a home tomorrow. That's real. It's quantifiable. It gets lost in the weeds. This is very clear, right? And the other area that we think borrowers who've bought a home in the last, say, 3 years where the rates have been a little higher, if they're going to do a refinance with Fannie or Freddie and they paid loan level price adjustments for whatever reason last time, and they've made 12, 18 months, whatever you consider an appropriate seasoning period of on-time payments, why would you have them pay loan level price adjustments again? They've demonstrated that they can make the payment at a higher level. And then more borrowers will be able to take advantage as these rates improve a little and improve their cash flows with no additional risk to the GSEs or the taxpayer. So we've also talked about not requiring loan level price adjustments on rate term refis to borrowers with clean payment histories. Again, that would be noticeable tomorrow, put people in the money for a refinance to take advantage of better cash flow associated with these rates as they drop.
Great information there. I did want to dig a little bit deeper into the credit report, right? The cost of the credit reporting. So I think, this really hits industry. I don't know that the consumer thinks about it the same way, but talk about especially, do we need a tri-merge credit report and what you guys are advocating for there?
Sure. The answer is no, we do not need a tri-merge credit report. And from a borrower's perspective, the line on the closing disclosure that says credit report, which is what they actually pay, has gone up multiples in the past 3 years. Is it the largest expense at a closing? No, it's not, but it's gone up dramatically. And the hidden cost that is paid by people whose loans close is that lenders have to pull these credit reports very early in the process, because if you call up a lender and say, what's your rate? What kind of programs do I qualify for? You can't really have the conversation without pulling the credit reports. So there are so many loans. We've heard members say only 18 or 20% of the borrowers whom they pull credit on end up closing because either they never find a house in this period of constrained availability, or they choose another lender, or their loan is denied, or they cancel for whatever reason. And so they're left holding the bag on 78 or 80% of the credit report bills, and they can't afford to just absorb that. So that all goes into their margins. So it doesn't go to a single line on the closing disclosure, but their rate and points that they're quoting include having to pay for all of these credit reports, 3 credit reports and 3 scores for loans that don't close. So there's a double benefit to the consumer by fixing this. And so from a risk perspective, why are we confident that 3 scores and 3 credit reports are unnecessary on conventional loans with credit scores of 700 or above? Because 3 years ago, maybe it's going on 4 years, I can't remember, FHFA said, well, you don't really need 3, you can have 2. They moved from requiring a tri-merge to requiring a bi-merge. It never got implemented. And we have worked with them, and I know they've updated their analysis to see whether a single score at least for the higher scores, would give them all the risk management information they need. And we think that answer is yes. Back in the old days, and yes, I'm now celebrating 40 years in the industry. Back in the old days, the bureaus had geographic differences. So perhaps if you lived in Georgia, maybe Equifax was the best bureau, or had the most coverage in your area. And if you lived in California, maybe it was Experian. I'm just making it up. But there were different regions where different bureaus had better coverage. That is pretty much a thing of the past now. And data we have seen about the dispersion of credit scores and how much difference it would make if you got 3 and used the middle score versus just using 1 score, that has really been mostly wrung out of the system. And I'll quote you statistics that come from Fannie Mae, which is their weighted average credit score is 757. Wow. 75% of their loans have a score of 740 or above, and only 6% have a score of 680 or below. So clearly, the creditworthiness is manifest, and we are having every borrower pay hundreds of dollars more than they need to for very limited, if any, benefit from a risk management perspective.
I think one of the other things, if you look at, single file credit reports, other parts of the consumer finance universe use that with pretty good results, correct?
Exactly. So you can go buy a $125,000 Cadillac Escalade with a single pole, probably costs you $8 or $12. You can get a home equity loan from a lot of lenders, including many of our members who just use a single bureau. So yes, and what is better collateralized? An Escalade, a high CLTV home equity loan, or a first mortgage? So right. it just does not make sense that we are stuck in the past with this tri-merge requirement.
Well, before we go on to legislative action, really wanted to ask about LO comp rule. This is something we get asked about a lot. What's the latest on the LO comp rule?
Well, I'm glad you asked, Sarah, because we had a conversation on this last week with the administration. You may remember that dating back several years to at least the first Trump administration, we had asked the CFPB to consider changes to the loan officer compensation rule that, among other things, would let lenders improve the offer they make to consumers to meet competitive offers. Because since you cannot vary the compensation to the loan officer based on terms of the loan, lenders currently cannot say, okay, well, I'll offer you 6% with no points. And then if the borrower calls back and says, well, I got 5 7/8 with no points down the street, you can't lower your rate to 5 7/8 because that would be, well, you can, but you can't change the loan officer's compensation to be able to get there. And if you ask 100 loan officers whether they'd rather have 100 basis point commission on a $300,000 loan or 75 basis points in order to close the deal and match the rate down the street, 100 out of 100 will say, I'll take the 75, but the government doesn't let them do it. And I had a conversation a couple weeks ago with a very senior administration official, and I said, you're not going to believe this one, but a government regulation prohibits my members from improving the rate and points they quote to a consumer. And he, as I expected, couldn't believe it. And the conversation we had last week at the CFPB was that they need to make changes to this rule to allow this. And we're having a very favorable hearing from this CFPB. Now, you've seen the Bureau in the news a lot lately. They're not doing a lot. But the big news for your listeners is that, pursuant to a recent court order, Acting Director Vogt has asked for a $145 million distribution from the Fed to fund the CFPB's operations. And we have confirmed that they will get busier on writing and revising rules, which is what's required to make this change. So there's reason to be optimistic. As with everything that requires a rule writing, this is not an overnight, this will take longer than tomorrow, but the wheels are in motion, and we're optimistic that this is back on the agenda, and there will be people at the Bureau to work on it.
I appreciate that update, and that's encouraging. Like you said, I think so many of these things people aren't always aware of, right? Even the people who are running things may not know that, like, this, rule that everyone in our industry knows about, it could be holding things back.
Right, and in an era of affordability, and that being the buzzword of the day and the political hot potato, how can you defend a government rule that prevents lenders from making mortgages more affordable?
Seems like a good time to make some of these changes, and seems like you've had some very favorable hearings as well. So yes. That's good news. Okay, so let's talk about legislatively what's happening. So the Road to Housing, the Housing for the 21st Century Act, where does that stand?
Yes, the Road to Housing has passed the Senate, and the 21st Century Housing is the, if you like, companion piece of legislation in the House. It's a little bit of a different bill in that it excludes some of the provisions that were in the Senate's version of the Road to Housing. And frankly, we didn't like a couple provisions in the Senate bill, and the House version has stricken them. Like, for instance, there's, we think, a bad idea to effectively let consumers get a second appraisal anytime they don't like the value of the first one, have the lender pay for it, and then subject the lender to liability under the Truth in Lending Act and its treble damage component, which we think is bad legislation, and the House agrees with us, and it is not in the 21st Century Housing Act. So what we expect is that the House will probably, the House Financial Services Committee, I think, has voted on that bill, but we want to get it to the House floor. And then we hope there'll be a really old-fashioned thing called a conference, where you look at the Senate passed bill and the House passed bill, and you come up with a version that then can pass both chambers and be signed by the president. So there's some other priorities in House Financial Services at the moment, including a fairly contentious crypto markup, which is going to take precedence. But we do expect, as the winter goes on and we get into spring, and especially given the importance of housing affordability, that this legislation will have legs, and we just hope that it's a negotiated version between the House and the Senate.
I would think there's some gratification on your part to see housing be such a top priority issue for both, the White House and the legislature.
Yes, I remarked, Sarah, that the presidential election was the first in my memory where both parties were talking about housing and homeownership and affordability. And that is certainly carried through this first year of the Trump administration. And it does give us, as you point out, a really great opportunity to move on some long-held priorities and to try to get this market unstuck.
Well, I'm excited about what we might see come out of Davos. We don't know that, but we do know what you guys are going to have at your IMB conference in Amelia Island. Tell us a little bit about that.
Yes, well, as we're recording here, it's about 30 degrees. It'll be the high for the day in Washington, so we're looking forward to being at Amelia Island. It's February 2nd to 4th. For our Independent Mortgage Banker Conference. We're really excited, having over 600 already registered, and we'll certainly get many more between now and then. We'll have guests from Ginnie Mae and FHA and Shark Tank's Damon John, and many of the IMB leaders who make our industry transformative and exciting. So we hope to see you all down there at Amelia Island in just a couple weeks.
It's also nice to have, we're not in a government shutdown, so people from HUD and Ginnie can be there, and you can count on that.
Exactly, yes. That shutdown last fall was the longest we've had, and while it's already been replaced in the news cycle, we talked to people at agencies, and it was really 6 lost weeks of productivity. So those shutdowns are harmful.
They are. I so appreciate you taking time on this very busy day for you, for anybody in housing policy, to give us an update on all those things. So, Bob, thank you so much.
My pleasure, Sarah. Thank you.